Friends, thank you for being here today. What if I told you that on December 3rd, 2025, the American banking system quietly experienced something that should terrify anyone paying attention? While the financial media celebrated record stock prices and told you the system was flush with cash, U.S. banks rushed to the Federal Reserve's emergency window and borrowed $26 billion overnight. This isn't routine maintenance. This is vanishing in real time. Let me be precise about what this number represents. $26 billion borrowed in a single day through the standing repo facility, the second largest panic borrow since the facility's creation. The Federal Reserve and every mainstream analyst have spent years assuring you that banks are swimming in reserves, that the system holds $2.8 trillion in excess liquidity. If that's true, then answer me this. Why would banks suddenly need to borrow emergency cash at a penalty rate just to settle their daily books? The contradiction isn't subtle, it's screaming. But that's not the real problem. Beneath this $26 billion emergency withdrawal sits a $1.85 trillion time bomb that almost no one is discussing. Hedge funds, most of them operating out of unregulated Cayman Island shell companies, have built leveraged positions in Treasury securities so large and so fragile that a single day of frozen funding could detonate the entire structure. This is where the countdown quietly began. Here's the part they never put in the official reports. The SOFR rate, the secured overnight financing rate that serves as the baseline for trillions in financial contracts, spiked to 4.05% on that same day. The Federal Reserve's upper target limit? 4%. The Fed lost control of the steering wheel, and the vehicle is accelerating downhill. This part isn't a prediction, it's math. We are not discussing theory. We are discussing the plumbing of the entire financial system beginning to seize up in real time. And this part has already begun. Let me show you what actually happened, because the genesis of this crisis reaches back further than December 3rd. To understand why $26 billion represents a structural fault line and not a temporary glitch, you need to understand September 17th, 2019. That was the day the repo market, the hidden foundation beneath every stock, bond, and derivative in existence, suffered what insiders call a flash seizure. On that Tuesday morning, overnight repo rates exploded from roughly 2% to 10% intraday. 10%. Banks refused to lend to each other because they didn't trust each other's balance sheets. The entire system was hours away from a cascading freeze when the Federal Reserve was forced to intervene with emergency liquidity injections. They printed billions instantly, right there in the middle of a supposed economic expansion, just to keep the gears turning. This is the detail even analysts tend to miss. The standing repo facility that banks tapped on December 3rd was created specifically as a response to that 2019 crisis. It was designed to be an automatic safety valve, a way for banks to access emergency cash without the public panic that comes from seeing the Fed scramble. The facility was supposed to make these crises invisible. But this isn't even the part that scares me. The alarm just rang anyway. Despite having this supposedly foolproof backstop, despite the Fed's assurances of ample reserves, banks still rushed to borrow $26 billion in a single day. The safety valve wasn't enough. We don't have months. This is happening in days. Think of the standing repo facility like a pawn shop for banks. Here's what that looks like on the ground. When no other institution in the private market trusts you enough to lend you cash overnight, when the normal channels of liquidity have frozen up, you take your Treasury securities, hand them over to the Federal Reserve like pawning a watch, and receive emergency cash to survive until morning. The fact that you're using this facility at all carries what traders call stigma. It signals weakness. It tells the market you couldn't find a willing lender anywhere else. Banks are terrified to use the standing repo facility for exactly this reason. The optics are devastating. It broadcasts desperation. So when they use it anyway, when they borrow $26 billion despite the reputational damage, you know the situation behind the scenes is far worse than the public numbers suggest. This was inevitable the moment quantitative tightening began draining reserves from the system. But here's where common sense actually becomes your enemy. You might think $2.8 trillion in bank reserves means there's plenty of cash sloshing around. The simple logic does not apply here. Those reserves are not evenly distributed. They're not sitting in some collective pool that every bank can access whenever they need liquidity. The majority of those reserves are concentrated in just 5 massive institutions. Meanwhile, smaller banks and the broader market infrastructure operate on what I call a just-in-time liquidity model. They rely on continuous flows, on the assumption that cash will always be available when they need it. And this is where the first domino falls. On December 3rd, a convergence of Treasury settlements, month-end cash flows, and the ongoing effects of quantitative tightening drained the liquidity cup dry. The system discovered that ample reserves mean nothing if the cash isn't where it needs to be at the exact moment it's needed. The plumbing backed up. The gears ground without oil. And here is where the cascade becomes unstoppable. Let me show you the mechanism hiding in plain sight. Banks aren't just borrowing this emergency cash for their own operations. They're funding a gambling habit that dwarfs anything you saw before 2008. It's called the basis trade, and the notional size of these positions has reached $1.85 trillion. Here's the part nobody expects. The basis trade is technically an arbitrage. Hedge funds borrow cash in the repo market at low rates, use that cash to buy Treasury securities, and simultaneously sell Treasury futures to lock in a tiny spread. On paper, it's a risk-free bet. The profit margins are microscopic, often just a few basis points. So how do you make money on such thin margins? You lever up 20 times, 50 times. Some funds are operating at leverage ratios that would make a pre-crisis investment bank blush. This is not theoretical. It's observable. When you build a $1.85 trillion tower on borrowed cash, and that cash suddenly becomes unavailable or prohibitively expensive, the entire structure implodes in minutes. These are not positions you can unwind gracefully. These are not investments you can sell slowly over weeks. When the repo market seizes, when the overnight funding disappears, the basis trade doesn't suffer losses. It vaporizes. And here's where everything changes. 37% of net Treasury issuance over the past year has been absorbed by unregulated hedge funds, most of them operating through Cayman Island vehicles that face no disclosure requirements and no leverage limits. The United States government's ability to fund itself, to roll over trillions in maturing debt, now depends on the solvency of shadow banking entities that could collapse overnight if repo funding freezes for even a single trading session. Because what comes next is worse. The standing repo facility can provide emergency cash to banks, but it cannot provide emergency cash to hedge funds. When these levered positions blow up, when margin calls hit and forced selling begins, the Treasury market itself goes no bid. That means no buyers, no liquidity, no functioning market for United States government debt. This is the crack that becomes an earthquake. But once this shifts, everything above it starts to shake. Let me cut through the noise and show you exactly how this contagion is spreading right now. The $26 billion emergency borrow wasn't an isolated incident. It was a symptom of 3 separate fault lines converging at the same moment, and each one alone would be cause for alarm. Together, they create what I can only describe as a mathematical endgame. The first fault line is what traders call the spread break. On December 3rd, the SOFR rate, which is supposed to trade within the Federal Reserve's target range, spiked to 4.05%. The Fed's upper limit? 4.0% exactly. This part is non-negotiable. When the benchmark rate that determines pricing for trillions in financial contracts breaks above the Fed's control range, it means the central bank has lost its most fundamental tool. They can no longer dictate the price of money in their own system. This is not a conspiracy. It is a stated reality visible in the data. The Federal Reserve sets a target range and uses various tools to keep rates within that band. When rates spike outside the range despite those tools, it proves the tools are no longer adequate. The market is more powerful than the central bank's interventions. And this part has already begun. Here's what that looks like on the ground. For the average money market fund manager, for the treasurer of a corporation holding short-term cash, for anyone who assumed overnight rates were stable and predictable, December 3rd was the day the rules changed. Suddenly, the cost of maintaining liquidity became unmoored from the Fed's guidance. Contracts priced off SOFR, derivatives hedged against SOFR, entire portfolios structured around SOFR stability. All of them experienced a shock that shouldn't have been possible in a system with ample reserves. But that's not the real problem. The second fault line runs deeper, and it involves something the Federal Reserve desperately wants you to ignore. Banks are hoarding cash, not lending it, not circulating it, hoarding it like families stockpiling food before a storm. And here's the part the experts gloss over. They're hoarding because their balance sheets are hemorrhaging in slow motion. U.S. commercial banks are sitting on approximately $400 billion in unrealized losses. These are losses that exist in reality, but haven't been officially recognized yet because the banks are using accounting rules that let them pretend long-dated bonds are still worth face value. What I call the big secret of the entire system is that these losses become realized losses the moment depositors start withdrawing cash at scale or when the bank needs to sell securities to raise liquidity. So here's the trap. Banks hold reserves, but they won't lend those reserves into the repo market because they might need that cash to cover withdrawals or plug holes in their own balance sheets. The reserve number the Federal Reserve points to, that $2.8 trillion figure, is functionally frozen. It exists on paper, but cannot move through the system because the institutions holding it are terrified to let it go. This is where the countdown quietly began, back when interest rates first spiked and bond portfolios started showing massive paper losses. The data forces one conclusion. The system doesn't have a liquidity problem in the aggregate. It has a liquidity distribution problem that is mathematically unsolvable without either forcing banks to recognize their losses or printing enough new money to paper over the holes. Neither option ends well. And here is where the cascade becomes unstoppable. The third fault line involves the Cayman whale. Let me be precise about what this means. Unregulated hedge funds operating out of Caribbean tax havens now hold such enormous positions in U.S. Treasuries that they've become systemically important without anyone officially acknowledging it. 37% of net issuance. That's not a peripheral player. That's not a side bet. That's the market. These funds don't disclose their leverage ratios. They don't report to the SEC. They don't face capital requirements or stress tests. They exist in a regulatory shadow specifically designed to avoid oversight. And they've built the $1.85 trillion basis trade on top of repo funding that just proved itself unreliable on December 3rd. Here's the part they never put in the official reports. When you concentrate that much Treasury ownership in unregulated, highly leveraged, offshore vehicles, you created a default in all but name. Not a default by the U.S. government on its debt obligations, a default by the market structure itself. A collapse in the mechanism that connects Treasury issuance to actual buyers. This sounds insane, but the data is unambiguous. If the repo market freezes for more than a day, if the standing repo facility proves insufficient during the next spike, these hedge funds face immediate margin calls. They will be forced to dump Treasuries into a market with no bids. Prices will gap down, yields will spike, and the Federal Reserve will face a choice between watching the Treasury market collapse or printing trillions to become the buyer of last resort. We don't have months. This is happening in days, because what the December 3rd event revealed is that we are already operating at the edge of the system's capacity. The emergency facility had to deploy $26 billion just to keep things functioning during a relatively minor stress event. What happens during a major one? Let me show you what actually happened to the system's shock absorber, because this is the piece that makes the entire structure unstoppable. The reverse repo facility, which held $2.4 trillion in overnight cash just 18 months ago, has collapsed by 91%. It now holds roughly $200 billion. That cushion, That buffer that money market funds use to park excess cash with the Fed has evaporated. This is the moment small businesses get crushed, even though they don't know it yet. When the reverse repo facility held trillions, it meant there was a massive pool of cash that could flow back into the system during moments of stress. Money market funds could pull cash out of the Fed and lend it into the repo market, providing liquidity exactly when it was needed most. That safety valve has been drained. The buffer is gone. And this part isn't a prediction, it's math. So now walk through the logic with me. The Treasury Department needs to issue approximately $2 trillion in new debt every year just to fund the government and roll over maturing securities. Wartime pace in peacetime. Banks are hoarding cash and sitting on $400 billion in unrealized losses. The reverse repo facility has been drained by 91%, removing the market's primary shock absorber. And $1.85 trillion in leveraged basis trades depend entirely on smooth repo market functioning. This is not theoretical. It's observable. On December 3rd, the system experienced a relatively minor liquidity crunch, and it required a $26 billion emergency intervention. The SOFR rate spiked above the Fed's control range anyway. The plumbing seized up despite ample reserves, and we haven't even reached the breaking point yet. Let me show you the forensic evidence that proves this rot is spreading beyond the repo market itself. Bitcoin, which had been trading near all-time highs, experienced a sudden 7% drawdown in the days surrounding December 3rd. Not because of any Bitcoin-specific news, not because of regulatory announcements or technical failures, because liquidity was being drained from the entire system, and leveraged positions across all asset classes had to be unwound. This is where common sense actually becomes your enemy. Most people look at Bitcoin and see a speculative technology asset. The insiders see a highly liquid, 24/7 market that serves as a release valve for global liquidity stress. When repo markets freeze, when cash becomes unavailable in traditional funding channels, leveraged traders sell whatever they can sell instantly. Bitcoin crashes not because it's worthless, but because it's one of the few assets that can be liquidated at 3 in the morning on a Sunday. The same pattern appeared in technology stocks. Nvidia, the poster child of the AI boom, saw unusual selling pressure despite no change in its fundamental story. For pensions, this is catastrophic. These aren't retail investors panic selling. These are sophisticated funds dumping high-quality assets because they need to raise cash immediately to meet margin requirements in the repo market. This was inevitable the moment the reverse repo facility started draining below critical levels. And this is where the first domino falls in earnest, because the Federal Reserve now faces an impossible choice, a true binary trap with no escape route. Let's walk through both options so you understand exactly why this ends in crisis regardless of which path they choose. Option A. The Fed continues quantitative tightening. They keep draining reserves from the system, reducing their balance sheet, trying to unwind the emergency measures from the pandemic era. What happens? The repo market seizes up completely. The standing repo facility gets overwhelmed. The basis trade implodes. $1.85 trillion in leveraged positions vaporize. The Treasury market goes no bid. Yields spike. The cost of servicing $38 trillion in federal debt becomes mathematically impossible. The sovereign debt spiral accelerates into a death spiral. Option B. The Fed restarts quantitative easing. They begin printing new money, expanding their balance sheet again, flooding the system with fresh reserves to prevent the repo market from freezing. What happens? Inflation, which had finally started to moderate, reignites immediately. Bond markets, which had been assuming the Fed would maintain discipline, panic. Long-term Treasury yields spike anyway, but for the opposite reason. Not because of a liquidity crisis, but because of an inflation crisis. The dollar gets crushed. Real purchasing power evaporates. You become a millionaire on paper, but poorer at the grocery store. But once this shifts, everything above it starts to shake. Because there is no third option. There is no magical middle path where the Fed threads the needle perfectly. The architecture of the system has been built on contradictions that can no longer coexist. You cannot have ample reserves and frozen repo markets. You cannot have quantitative tightening and stable leverage. You cannot have $2 trillion in annual deficits and a functioning bond market without either printing money or accepting collapse. This is the moment the clock actually starts, not when the crisis fully erupts, not when the headlines scream panic. Right now, in the quiet space between December 3rd and whatever comes next. This is the window where preparation is still possible, where you can still move assets before the herd realizes what's happening, because what comes next is worse. Let me show you what actually happened in the days following December 3rd, because the contagion doesn't announce itself with sirens and flashing lights. It spreads through the cracks in the system, quietly, methodically, until the entire edifice starts to crumble. And this part has already begun. The first crack appeared in the commercial paper market. For those unfamiliar, commercial paper is short-term debt that corporations issue to fund day-to-day operations, payroll, inventory, the basic machinery of business. It's supposed to be the most boring, stable corner of finance. But in the week after the repo spike, spreads on commercial paper widened by 15 basis points. That might sound trivial. It's not. Here's what that looks like on the ground. A 15 basis point increase in funding costs might seem like a rounding error, but when you're a corporation rolling over billions in short-term debt every month, that's real money vanishing from operations. More importantly, it's a signal. It means the buyers of commercial paper, the money market funds and cash managers who are supposed to provide infinite demand for high-quality short-term debt, are suddenly nervous. They're demanding higher yields to compensate for risk they didn't think existed a month ago. This is the detail even analysts tend to miss. Commercial paper spreads widening isn't the crisis itself. It's the leading indicator. It's the canary in the coal mine signaling that liquidity stress in the repo market is metastasizing into the broader funding ecosystem. And we haven't even reached the breaking point yet. The second crack appeared in mortgage-backed securities. The spreads between mortgage rates and Treasury yields, which had been relatively stable, suddenly widened by 20 basis points. For the average household, this means the 30-year mortgage rate that should have been 6.2% is now 6.4%. For a $300,000 mortgage, that's an extra $40 a month, $500 a year, $15,000 over the life of the loan. But that's not the real problem. The real problem is what this spread widening reveals about market structure. Mortgage-backed securities are supposed to be among the most liquid instruments in existence. They're guaranteed by government-sponsored enterprises. They trade in enormous volumes. They're held by every major bank and pension fund. When spreads widen despite no change in default risk or prepayment expectations, it means dealers are pulling back. Market makers are reducing inventory. Liquidity is draining from a market that's supposed to be rock solid. This part isn't a prediction. It's math. When dealers reduce inventory in MBS, it means they're conserving balance sheet capacity. They're preparing for stress. They're pulling back from market-making activities because they need to preserve cash and capital for their own survival. This was inevitable the moment the repo market proved unreliable. And here is where the cascade becomes unstoppable, because we are now facing what I call the convergence, three massive forces hitting simultaneously, each one amplifying the others in a feedback loop that cannot be stopped without breaking something fundamental. Force number one, relentless supply. The United States Treasury is on track to issue over $2 trillion in new debt this fiscal year, not because of a recession or a war or an emergency, because the structural deficit has become so enormous that even with record tax revenues, the government must borrow $2 trillion just to keep the lights on. This is vanishing in real time. Every month, every week, the Treasury must find buyers for tens of billions in new securities, and the pool of willing buyers is shrinking. Force number two, vanishing demand. We've already discussed the reverse repo facility collapsing by 91%. But let's be precise about what that means for Treasury demand. When money market funds held $2.4 trillion at the Fed's reverse repo window, it meant they had dry powder, cash they could deploy instantly if attractive opportunities appeared. That cash is gone, drained, and it's not coming back unless the Fed restarts QE, which triggers the inflation trap we discussed earlier. But here's the part they never put in the official reports. Foreign buyers are pulling back too. China's Treasury holdings have fallen by over $200 billion from their peak. Japan, historically the most reliable buyer, is now a net seller as they desperately try to defend the yen and manage their own debt crisis. The buyer base that absorbed U.S. debt for decades is walking away, and this part has already begun. Force number 3, hidden leverage. That $1.85 trillion basis trade sitting on top of the repo market isn't just big, it's catastrophically concentrated. Let me show you what actually happened when I started digging into the data. A handful of hedge funds, maybe 20 or 30 firms, control the vast majority of these positions. They're all using the same strategy. They're all levered 20 to 50 times, and they're all dependent on the exact same funding source, overnight repo. This sounds insane, but the data is unambiguous. If one of these funds experiences a margin call and is forced to unwind, the selling pressure hits the Treasury market simultaneously, with every other fund facing the same pressure. There's no diversification, no natural buyers stepping in, just a cascade of forced liquidation that feeds on itself. This is where common sense actually becomes your enemy. You assume markets are resilient because they're big, but size without diversity is fragility disguised as strength. So here's the moment the clock actually starts ticking towards zero. We are facing a convergence where Treasury supply is accelerating, natural demand is vanishing, and the artificial demand from leveraged hedge funds is built on repo funding that just proved itself unstable. These three forces don't balance out. They compound. They create a debt spiral that math says cannot be resolved without either printing trillions or defaulting. There is no third path. Let me cut through the noise and address the psychological trap that prevents most people from seeing this clearly. It's called normalcy bias, and it's hardwired into human psychology. Your brain is designed to assume tomorrow will look roughly like yesterday. When you wake up and the lights still work, the grocery store still has food, the ATM still dispenses cash, your mind interprets this as evidence that the system is stable and will remain stable. But this isn't even the part that scares me. The part that scares me is that normalcy bias doesn't just prevent you from seeing the crisis coming. It prevents you from acting even after you've seen the warning signs. On December 3rd, the repo market screamed for help. $26 billion in emergency borrowing. SOFR spiking above the Fed's control range. And what did the stock market do the next day? It rallied because participants assumed the crisis had been contained, that the Fed's intervention proved the system works. Here's the part the experts gloss over. The intervention didn't prove the system works. It proved the system is dependent on interventions. It proved we're operating at the edge of capacity where even minor stress events require emergency measures. And the next stress event is already forming. Let me show you what actually happened in Japan, because this is the domino that's about to tip and take everything else with it. The Bank of Japan, after 3 decades of zero interest rates, has finally started raising rates. Not aggressively, not dramatically, just tiny, incremental moves from essentially zero to barely positive. And even these microscopic increases are causing chaos. The yen carry trade, where investors borrowed yen at 0% to buy higher yielding assets around the world, is beginning to unwind. Japanese institutions that bought trillions in foreign bonds are facing currency losses as the yen strengthens. Japanese pension funds that bought U.S. treasuries are watching those positions lose value as U.S. yields rise. And this is the crack that becomes an earthquake, because Japanese institutions are among the largest holders of U.S. debt outside of the Federal Reserve itself. When Japan stops buying, when they become net sellers to repatriate capital and manage their own crisis, It removes one of the critical pillars supporting the U.S. Treasury market. And we don't have months for this to play out. The yen has already strengthened 15% from its lows. Japanese institutional flows have already turned negative. This is happening in days, not years. So let's walk through the endgame scenario, because I want you to understand exactly what mathematical inevitability looks like. The Treasury auctions in early 2026 will be the test. The government will attempt to sell hundreds of billions in new debt into a market where domestic banks are hoarding cash. Foreign buyers are pulling back, leveraged hedge funds are on the edge of implosion, and the Fed is either continuing QT or restarting QE, both of which lead to disaster. One of two things happens. Either the auctions fail, meaning not enough buyers show up and yields spike violently to clear the market, or the Federal Reserve steps in as buyer of last resort, directly monetizing the debt and reigniting inflation immediately. There is no scenario where we muddle through. The math doesn't allow it. This is not theoretical. It's observable. The architecture is already cracking. The repo market seizure on December 3rd was the warning shot. The question isn't whether the system breaks. The question is whether you'll still be holding paper claims when it does. Because here's what I need you to understand about the money illusion. You look at your brokerage account and see numbers going up. You see the S&P at record highs. You see your 401k growing, and your brain interprets this as wealth. But those numbers are denominated in dollars. Those stocks are claims on corporate earnings denominated in dollars. Those bonds are promises to pay you back in dollars. Everything you own exists within the very system that's fracturing. Let me be precise about what happens when the repo market truly seizes, when the Treasury market goes no bid, when the Fed is forced to print trillions to prevent immediate collapse. Your account balance might show the same numbers or even higher numbers, but the purchasing power of those numbers evaporates. You wake up a millionaire on paper and discover that $1 million buys what 300,000 used to buy. The wealth didn't disappear. It was stolen through inflation, through currency debasement, through the mathematical necessity of resolving unpayable debts. This is the moment small businesses get crushed in earnest. The entrepreneur who built equity over decades, who saved diligently, who followed all the rules, watches that equity lose half its real value in 18 months. The retiree on a fixed pension discovers that fixed income means fixed poverty. For pensions, this is catastrophic beyond comprehension. The promises made to workers, the benefits accrued over careers, all of it denominated in currency units that are about to mean far less than when the promises were made. So here's the binary choice you face right now, today, in this quiet moment before the crisis goes mainstream. Do you want to hold counterparty risk or bearer assets? Let me explain the difference, because this is the only decision that matters. Counterparty risk means your wealth depends on someone else fulfilling a promise. Bank deposits are counterparty risk. The bank promises to give you your money back. Stocks are counterparty risk. The corporation promises to generate profits and share them with you. Bonds are counterparty risk. The borrower promises to pay you back with interest. All of these require the system to keep functioning, the repo market to keep funding, the banks to stay solvent, the currency to maintain value. Bearer assets are different. They exist independent of any promise. Gold is a bearer asset. It doesn't promise to pay you anything. It simply exists, holds value because it's scarce and no one can print more of it. Silver is a bearer asset. Bitcoin, for those willing to understand it, is a bearer asset. These don't depend on the repo market functioning. They don't require bank solvency. They don't care if the Treasury market goes no bid. Here's what that looks like on the ground for someone making this decision today. You can hold stocks and hope the liquidity crisis doesn't cascade. You can hold bonds and hope yields don't spike further. You can hold cash and hope inflation doesn't reignite. Or you can recognize that all three of those hopes depend on the same broken system resolving contradictions that math says are unresolvable. The alternative is stepping out of the line of fire entirely. converting claims on the system into assets that exist outside the system. This isn't about getting rich. This is about not getting poor. This is about preserving purchasing power through a reset that's coming whether you believe in it or not. Let me cut through the noise one final time. I'm not telling you the sky is falling tomorrow morning. I'm not saying you should panic or make reckless decisions. I'm saying the December 3rd repo spike was a warning sign that you need to take seriously. The system just proved it cannot handle even minor stress without emergency interventions. And the stress is about to get much worse. The Japanese unwinding is accelerating. The Treasury issuance is relentless. The reverse repo cushion is gone. The basis trade is a loaded gun. And the Federal Reserve has no good options, only choices between different kinds of destruction. This part is non-negotiable. The math forces one conclusion. You have a choice to make. You can choose to believe the system will somehow muddle through despite the mathematical impossibility. You can choose to trust that the same institutions that didn't see 2008 coming, that didn't prevent the repo crisis of 2019, that assured you inflation was transitory, will somehow navigate this perfectly. That's a choice. Or you can choose to trust math over institutions. You can choose to recognize that when debt becomes unpayable, when leverage becomes unsustainable, when the plumbing of the system seizes up despite ample reserves, something has to break, and you can position yourself accordingly before the herd figures it out. History favors the prepared, and the window for preparation is closing. Not in years, not in months, in weeks, because the next Treasury auction is coming. The next repo spike is coming. The next forced unwind of the basis trade is coming. And when it does, the emergency measures won't be enough. The standing repo facility will be overwhelmed. The Fed will face its impossible choice. And the great reset from paper wealth to real assets will accelerate beyond anyone's control. Friends, I'm not here to tell you what to do. I'm here to show you what's happening in real time, to connect the dots the mainstream financial media either doesn't see or doesn't want you to see. The December 3rd repo spike wasn't a glitch. It was a preview. The question isn't whether the system survives in its current form. The question